I'm going to tell you something that will make you uncomfortable. Most people over 50 are making a mistake so catastrophic, so absolutely fatal, that it will determine whether they retire with dignity or die broke and dependent on their children. And the worst part, they don't even know they're doing it. This isn't about picking the wrong stocks. It's not about missing out on Bitcoin or Amazon. It's far more fundamental, far more devastating than that. The mistake is this: they're still playing offense when they should be playing defense. At 50, 60, 70 years old, they're still chasing returns like they're 25. They're still gambling. They're still trying to catch up. And that desperation, that refusal to accept reality is what destroys them. I've watched it happen for nearly a century. Smart people, successful people, people who should know better, all making the same lethal error. They hit middle age, look at their net worth, panic, and do something stupid. They leverage up. They chase hot tips. They dump their savings into whatever CNBC is screaming about that week, and then they lose it all. Not slowly, not gradually, catastrophically. Because here's the brutal arithmetic that nobody wants to face. Losing half your money at 60 is not the same as losing half your money at 30. At 30, you have 3 decades to recover. At 60, you might not live another 3 decades. And even if you do, you won't have the energy, the health, or the time to start over. This is the reality. At 50 and beyond, you don't get do-overs. You don't get to hit reset. Your mistakes become permanent. So when I tell you that 90% of people over 50 are making a deadly investment mistake, I'm not exaggerating. I'm describing an epidemic of financial suicide that I've witnessed my entire life. I was born in 1924, right into the teeth of what would become the Great Depression. By the time I was old enough to understand the world was ending. Banks collapsed, businesses vanished, farms were abandoned. Men who wore suits on Monday were standing in bread lines by Friday. My grandfather went bankrupt. My father, a lawyer, watched his clients disappear because nobody could pay their bills. I grew up surrounded by the wreckage of financial arrogance, and I learned something that most people today have never learned: stability is an illusion. Prosperity is temporary, and the only thing that keeps you alive when the world collapses is what you've saved, not what you've spent. The families that survived the Depression weren't the smartest. They weren't the most ambitious. They were the most conservative. They lived below their means. They avoided debt. They stayed liquid. The families that went under, they were leveraged. They were overconfident. They thought the good times would roll forever. I remember one man in particular, a banker, well-respected, drove a nice car, lived in a big house. When the crash came, it turned out he owned none of it. The bank owned the car. The bank owned the house. And when the bank collapsed, he had nothing. He thought he was rich. He was just pretending. That image burned itself into my brain. I decided right then, as a boy, watching grown men cry over lost fortunes, that I would never play that game. I would never mistake leverage for wealth. I would never confuse looking rich with being rich. That decision, made before I was even a teenager, probably saved me more money than any investment I ever made. Because the Depression taught me the most important financial lesson of all: survival beats brilliance, every single time. You can be a genius. You can have a Harvard degree. You can understand economics better than anyone. But if you're leveraged when the storm hits, you're finished. The people who made it through weren't trying to get rich. They were just trying not to go broke. And that simple goal, that boring, unglamorous goal, is what kept them alive. Here's what happens to most people when they hit 50. They look around and realize they're behind. Their neighbor retired early. Their college roommate sold a business. Their brother-in-law made a killing in real estate. And suddenly they feel poor. Not actually poor, just poor compared to someone else. That's envy. And envy at 50 is a death sentence. Because envy makes you do stupid things. It makes you take risks you shouldn't take. It makes you compare your chapter 7 to someone else's chapter 20. and it pushes you into investments you don't understand with money you can't afford to lose at an age when you can't recover. I watched this happen to a man I knew. Brilliant lawyer, made good money his whole life, lived well but not extravagantly. At 55, he went to a dinner party and heard some hedge fund manager brag about his returns. The lawyer went home that night feeling inadequate. He had $1 million saved. The hedge fund guy had 10 million. And instead of being grateful for what he had, the lawyer became obsessed with catching up. He started trading options. He started leveraging his portfolio. He started chasing momentum stocks. Within 3 years, he'd lost more than half his net worth. Not because he was stupid, but because he forgot the most basic rule: at 50, you don't have time to be clever. The young can afford to gamble. If they lose, they have 30 years to rebuild. But at 50, every dollar you lose is gone forever. You're not getting it back. Your earning years are ending. Your health will decline. Your energy will fade. This is not pessimism. It's arithmetic. And the deadly mistake that 90% of people over 50 make is pretending that arithmetic doesn't apply to them. They act like they're still 30. They chase growth like they have unlimited time. They take risks like they have unlimited chances. They don't. Wall Street loves people over 50. You know why? Because they have money and because they're desperate. It's a perfect combination for selling garbage. I've seen it 1,000 times. Some smooth-talking broker walks into an office, sits down with a 60-year-old executive and pitches him on something exotic. Structured notes, derivatives, emerging market bonds, currency hedges. It all sounds sophisticated. It all sounds like the kind of thing smart people do. And the executive who spent his whole life being smart thinks, why not? Here's why not. Complexity is the enemy. The more complicated an investment is, the more likely you're the sucker in the deal. Because complexity hides risk, it hides fees, and it hides the fact that the person selling it to you doesn't actually care if you make money. They get paid either way. Buffett and I built our entire fortune on simplicity. We bought businesses we understood. We held them forever. We didn't use leverage. We didn't hedge with options. We didn't speculate in currencies. Boring, absolutely. But boring works. Boring compounds. Boring lets you sleep at night without waking up at 3 a.m., wondering if you just lost your retirement in some trade you don't even understand. I'll tell you a secret about rich people, the ones who stay rich. They don't own complicated things. They own simple things that work decade after decade. Coca-Cola, Johnson & Johnson, Procter & Gamble, insurance companies, boring, durable, cash-generating machines. Meanwhile, the people who go broke, they're always chasing the next big thing, the next hot sector, the next revolutionary technology. And they lose money not because those things don't work, but because they don't understand them well enough to know when to get out. At over 50, if you can't explain an investment to your spouse in 60 seconds, you shouldn't own it, period. Because the world is full of people trying to sell you things you don't need. And at your age, you can't afford to learn expensive lessons. There's a psychological trap that catches almost everyone over 50, and it's devastating. It's the belief that you're behind and that you need to catch up fast. You look at your 401k balance. You run the numbers. You realize that at your current savings rate and investment returns, you won't have the retirement you imagined. Maybe you thought you'd retire at 65. Now you're thinking 70, maybe 75. So what do? You panic. And panic makes you stupid. You start looking for shortcuts, higher returns, faster growth. Someone tells you about a real estate syndication that's returning 15% a year, or a private equity fund that's doubling money every 5 years, or a cryptocurrency that's going to revolutionize everything, and you think this is it, this is how I catch up. Let me tell you what happens next. You lose money, not all of it necessarily, but enough to hurt, enough to set you back years, enough that you'll never actually catch up. I knew a dentist once, good man, hardworking, saved reasonably well. his whole career. At 58, he had about $800, 0 inches his retirement accounts. He did the math and realized it wasn't enough for the lifestyle he wanted. So he took a chunk of it, maybe $200, 000, and put it into some high-yield bond fund his buddy recommended. Sounded safe. It had bond in the name. 2 years later, that $200, 000 was worth $80, 000. The fund had blown up. Turns out high yield means high risk. But he didn't know that. Or he didn't want to know that. Now he's 60, working longer than he planned, and he'll probably never recover what he lost. That's the tyranny of catching up. It makes you desperate, and desperate people make terrible investors. Here's what I learned over a lifetime: you can't make up for lost time by taking bigger risks. That's not courage. That's delusion. If you're 50 and behind, your only realistic option is to accept reality, adjust your expectations, and play the long, boring game. Save more, spend less, own simple things, and let time do the work. It won't be glamorous. It won't make you rich overnight, but it will keep you solvent. And at 50, solvency beats speculation every single time. I've spent my whole life trying to avoid 3 things: debt, drama, and dumb people. At 50 and beyond, these 3 poisons become even more lethal. Let's start with debt. When you're young, debt is dangerous. When you're old, debt is fatal. Why? Because your ability to earn is declining. Your health is uncertain. Your time is running out. If you're 60 years old and you owe money, what's your plan? Work until you're 80. Hope the stock market bails you out. I've seen people destroy their entire retirement because they couldn't resist borrowing. Home equity loans, margin accounts, business loans for some side venture they thought would make them rich. It never works out the way they imagine. Debt amplifies mistakes. If you make a bad investment with cash, you lose that cash. If you make a bad investment with borrowed money, you lose the cash and you still owe the debt. It's a double disaster. Buffett and I built Berkshire Hathaway without meaningful leverage. People thought we were leaving money on the table. Maybe we were. But we also never faced a margin call. We never had to sell assets at the worst possible time because some bank wanted their money back. At over 50, every dollar of debt you carry is a claim against your future freedom. Pay it off. Don't take on more. And if someone tries to sell you on good debt run, next drama. I've buried a child. I've lost an eye. I've been divorced. Life gave me enough real tragedy. I had no interest in manufactured chaos. But so many people create their own problems. Bad marriages they won't leave. Toxic friendships they won't end. Lawsuits over trivial nonsense. Family feuds over inheritance. All of it drains energy. All of it distracts you from what matters. And all of it costs money, either directly in legal fees or indirectly in bad decisions made while you're emotionally compromised. At 50, you don't have energy to waste on drama. Cut it out. Walk away from toxic people. Settle disputes. Move on. Finally, dumb people. This one is underrated, but it might be the most important. Who you spend time with determines your outcomes. If you're surrounded by gamblers, you'll gamble. If you're surrounded by pessimists, you'll give up. If you're surrounded by fools, you'll make foolish decisions. I made it a rule early in life: only associate with people I admire, trust, and respect. Everyone else I cut loose. It sounds harsh, but it's liberating, because the world is full of people who will drag you down. Unreliable business partners, friends who always need money, relatives who pressure you into bad investments. At over 50, you can't afford these people. Your time is too valuable. Your money is too precious. Your peace of mind is too fragile. So here's the Munger prescription for life after 50. Eliminate debt, eliminate drama, eliminate dumb people. Do those 3 things and you'll already be ahead of 90% of humanity. Let me paint you a picture of 2 retirements. Retirement A, you're 68 years old. You have $1.2 million saved. No debt. A paid-off house. A portfolio of dividend-paying stocks that generates $40,000 a year. Social Security adds another $30,000. You live simply, travel occasionally, help your grandkids with college. You sleep well. You have no financial stress. Retirement B, you're 68 years old. You have $1.2 million saved. But you also have a mortgage, a car payment, credit card debt. Your portfolio is full of growth stocks that don't pay dividends. You're hoping for big gains to fund your lifestyle. The market drops 20%. You panic. You start selling at the wrong time. You can't sleep. You're constantly worried about money. Same net worth. Completely different outcomes. The difference isn't the amount of money, it's the structure. Most people over 50 obsess over how much they have. They should be obsessing over how they have it. Do you own things that generate income, or do you own things you're hoping to sell for a profit? Do you have a margin of safety, or are you stretched thin? Can you survive a recession, or would a market drop destroy you? These questions matter more than your account balance. I've known people with $5 million who were stressed out of their minds because it was all tied up in illiquid investments or speculative bets. And I've known people with $500,000 who were perfectly content because it was in simple income generating assets with no debt weighing them down. Wealth isn't about the number. It's about durability. At over 50, your goal should be to build a retirement that can withstand anything. Market crashes, inflation, health problems, family emergencies. And the way you do that isn't by chasing the highest returns. It's by avoiding the biggest risks. I'm going to admit something that cost me billions of dollars. Warren and I missed the technology boom. We watched Microsoft, Amazon, Google, Apple, all of them grow into trillion-dollar companies. And we didn't own them, not because we were stupid, but because we didn't understand them well enough to bet big. People mocked us. They said we were out of touch, old-fashioned, dinosaurs. Maybe. But we're still here. And a lot of the people who mocked us went broke chasing .com stocks in 2000 or over-leveraging into tech stocks in 2022. Here's what nobody tells you about technology investing. For every Amazon, there are 100 pets.coms. For every Apple, there are 1,000 forgotten startups that burned through millions and disappeared. And at over 50, you don't have the margin for error to play that game. Yes, you could have gotten rich buying Amazon in 1997. You could have made a fortune buying Tesla in 2010. But you could have also lost everything buying Webvan or Theranos or WeWork or any of the 1,000 other revolutionary companies that turned out to be frauds or failures. The problem with technology is that it moves too fast. Business models change overnight. Competitive advantages evaporate. What looks like a sure thing today is bankrupt tomorrow. And unless you're deeply immersed in that world, you're guessing. You're not investing. You're gambling. I'll give you a rule I've lived by. If you can't predict what a business will look like in 10 years, don't buy it. Can you predict that people will still be drinking Coca-Cola in 10 years? Yes. Brushing their teeth with Colgate? Yes. Buying insurance? Yes. Can you predict what social media platform will dominate in 10 years? No. What phone operating system people will use? Maybe. What artificial intelligence company will win? Absolutely not. At over 50, you should be invested in things you understand deeply and that you're confident will still exist in a decade. Not because you're afraid of change, but because you're afraid of irreversible losses. I know this advice sounds boring. It sounds like I'm telling you to miss out on the future. Maybe I am. But I've seen too many people, especially people over 50, lose fortunes chasing the future. They buy whatever's hot. They follow trends. They read headlines and think they're informed. Then the trends reverse. The headlines change. And they're left holding assets they don't understand in businesses that are failing with no idea when to get out. That's not investing. That's Russian roulette. So if you're over 50 and tempted by some exciting new technology investment, ask yourself, do I really understand this, or do I just want to feel smart and current? Because wanting to feel smart is one of the most expensive emotions in investing. What actually works after 50. Let me give you the unglamorous truth about building and preserving wealth after 50. It's not exciting. It won't impress your friends. It won't make you feel like a genius. But it works. First, own boring, durable businesses. Companies that sell products people buy in good times and bad times. Food, household goods, healthcare, insurance, utilities. These businesses won't double overnight, but they won't collapse overnight either. And they'll pay you dividends year after year, giving you income you can live on without having to sell anything. Second, stop trying to time the market. You won't. Nobody can. Every year, thousands of professional investors with Harvard degrees and supercomputers try to time the market. Most of them fail. What makes you think you'll succeed? The amateur investor's advantage is patience. You don't have quarterly earnings calls. You don't have investors breathing down your neck. You can sit still for years, even decades, while your investments compound. Use that advantage. Buy quality. Hold forever. Third, build a margin of safety into everything. Keep more cash than feels comfortable. Own assets that can survive a depression. Avoid anything that requires the world to keep booming for you to be okay. Optimism is fine, but optimism without a margin of safety is stupidity. I grew up in the Depression. I've lived through multiple recessions, crises. The pattern is always the same. The people with margins survive. The people without it get wiped out. At over 50, you can't afford to get wiped out. Fourth, ignore the noise. Financial media exists to create anxiety. Every day there's a new crisis, a new opportunity, a new reason to do something. Don't. The more you trade, the more you react, the worse your returns will be. Stillness is your friend. Activity is your enemy. Fifth, focus on what you can control. You can't control the market. You can't control the economy. You can't control interest rates or inflation or what the Fed does. But you can control how much you spend, how much you save, what you own, how much debt you carry. Focus on those things. Ignore the rest. I know this advice sounds overly simple, but simplicity is the point. Complex strategies fail. Simple strategies executed with discipline succeed. At over 50, you don't need to be clever. You need to be calm, patient, and rational. Do that and you'll outlast all the clever people. Let me tell you why my partnership with Warren Buffett lasted more than 60 years, while most business partnerships implode within 5. It wasn't luck. It wasn't magic. It was compatibility, trust, and shared values. First, we trusted each other completely. If Warren said something, I believed him. If I said something, he believed me. No second guessing, no hidden agendas, no politics. That kind of trust is incredibly rare. And it saved us from the poison that destroys most partnerships, suspicion. Second, we balanced each other. Warren is more optimistic. I'm more skeptical. He sees opportunity. I see risk. Together we made better decisions than either of us would have made alone. Most people want a partner who agrees with them. That's a mistake. You want a partner who challenges you, who thinks differently, who catches your blind spots. Third, we agreed on fundamentals. We both hated debt. We both valued patience. We both believed in owning great businesses forever. When you agree on principles, you don't waste time arguing about tactics. Now, how does this apply to people over 50? Simple. At this stage of life, who you're partnered with in business, in marriage, and friendship matters more than ever. If you're married to someone who overspends, you'll never build wealth. If you're in business with someone who's reckless, you'll go down with them. If you're taking advice from someone who doesn't share your values, you'll make decisions you regret. At 50, you need to audit your relationships. Who's helping you, who's hurting you, who's rational, and who's dragging you toward chaos. And if the answer is uncomfortable, you need to make changes. I've seen too many people, especially men, destroy their finances because they were afraid to leave bad partnerships, bad marriages, bad business arrangements, bad friendships, They knew it wasn't working, but they stayed anyway, out of loyalty, out of guilt, out of inertia, and they paid for it in money, in stress, in wasted years. At over 50, you don't have years to waste. Every relationship in your life should either be adding value or it should be gone. That sounds cold, but it's liberation. Because once you cut out the people who drain you, you'll have energy for the people who matter. Buffett and I succeeded not because we were the smartest guys in the room. We succeeded because we didn't waste time with the wrong people. At your age, you should do the same. Here's a fact that the financial industry doesn't want you to know: most professional investors underperform the market. Mutual fund managers, hedge fund managers, private equity gurus, all of them on average do worse than a simple index fund over time. And they charge you fees for the privilege of losing your money. Why does this happen? Because active investing is hard. You have to be right about what to buy, when to buy it, when to sell it, and what to buy next. And you have to be right consistently, year after year, even when the market is doing things that make no sense. Most people can't do it. And yet the entire financial industry is built on convincing you that you need them to do it for you. At over 50, you're a prime target for this nonsense. You have money. You're worried about retirement. You feel like you need professional help. So some advisor walks in, shows you a fancy presentation, talks about alpha and beta and portfolio optimization, and convinces you to pay them 1% or 2% a year to manage your money. Here's what happens. They trade your account, constantly generating fees. They put you in expensive mutual funds that pay them kickbacks. And at the end of 10 years, you've made less than you would have by buying an index fund and doing nothing. But you paid them 6 figures for the privilege. I'm not saying all advisors are crooks. Some are honest, competent people. But the industry is structured to extract fees from you, not to maximize your returns. If you're over 50, here's what you should do. Keep it simple. Buy a diversified portfolio of low-cost index funds, or buy a basket of high-quality dividend stocks. Hold them. Reinvest the dividends. Don't trade. That's it. You don't need someone charging you 1.5% a year to tell you that. Because here's the math. If your portfolio earns 7% a year and you pay an advisor 1.5%, you're only netting 5.5%. That difference compounds against you for decades. Over 20 years, that fee will cost you hundreds of thousands of dollars. Is any advisor worth that? Maybe if they're saving you from making catastrophic mistakes. But most aren't. Most are just selling you the illusion of expertise while quietly draining your wealth. At over 50, you can't afford to give away 20-30% of your lifetime returns to someone who's probably not even beating the market. So be skeptical. Ask tough questions. And if you can't get straight answers, walk away. Because the best investment advisor you'll ever have is discipline, and discipline is free. I'm 99 years old as I write this. I've lived through the Great Depression, World War II, multiple recessions, crises, bubbles, and crises. I've watched thousands of people build wealth, and I've watched thousands of people destroy it. And the difference every single time comes down to one thing: discipline. Not intelligence, not luck, not timing, discipline. The people who made it, the ones who retired comfortable, who left something behind for their kids, who never had to worry about money in their final years, they all did the same boring things. They spent less than they earned. They saved consistently. They invested in simple, durable assets. They avoided debt. They stayed calm during crises. They ignored the noise. They didn't try to get rich quick. That's it. No magic, no secrets. Just discipline repeated over decades. And the people who failed, the ones who worked their whole lives and had nothing to show for it, who ended up bitter and dependent in old age, they all made the same mistakes. They spent too much. They chased returns. They took on too much debt. They panicked and sold at the wrong time. They followed the crowd. They couldn't sit still. At over 50, you're facing the most important financial decade of your life. What you do now will determine whether you retire with dignity or desperation. So let me leave you with one final question, the question that should haunt you Every time you're tempted to do something clever, something exciting, something risky, would you rather look rich today or be free forever? Because you can't have both. You can drive the fancy car, live in the big house, impress your neighbors. Or you can build real wealth, the kind that lets you sleep at night, the kind that doesn't evaporate when the market crashes, the kind that gives you independence. Most people choose the first option. They want to look successful, they want status, they want envy, and they pay for it with their freedom. The smart ones, the ones who make it, they choose freedom. They live quietly, they compound silently, and by the time they're 70, they're financially independent, while their flashy neighbors are still working. I chose freedom. Warren chose freedom. And we never regretted it. At over 50, you still have time to make the same choice, but not much time. So stop chasing, stop comparing, stop gambling with your future, play defense, own boring things, avoid stupidity, and when you're 70 sitting on a porch somewhere with no financial worries, you'll understand the goal was never to be rich. It was to never be fragile again.